unlisted investments? Well, it starts by us understanding what creates a market to invest in the first place. And that's all about companies, both listed and unlisted, that require capital to either service debt or grow their businesses. This creates a market for investment opportunity across listed and unlisted markets. So you attract capital in two ways, equity or debt. In the listed market, companies and government issue bonds as an IOU for future repayment of capital, plus return in the form of coupons at a future date. They also would issue shares, listed companies specifically, to attract capital, and in return, shareholder value increases or decreases based on daily market trade. This is, of course, dependent on a number of factors, which we won't go into detail in this webinar. In the unlisted market, small to medium-sized companies may not meet the requirements of the banks to attract capital in order to grow. Note my focus on the word grow. So they would go to the private market, private investors, for both debt financing through unlisted credit or equity ownership through private equity. However, in both markets, the requirement is the same, but the means of attracting capital is different. So listed assets include equities, bonds, listed property, and that's both local and offshore. Unlisted assets include private equity, hedge funds, and unlisted credit. The most important thing to understand is that listed assets are easily traded on an exchange, and information is publicly available to you and me to monitor movement on those specific assets. Whereas in the unlisted market, that information is only privy to the people that are involved in that specific investment or transaction. So before we understand the differences between listed and unlisted, or more information on the differences between these two asset classes, let's talk about regulation. Nothing we do in South Africa happens without regulation being followed, especially when it comes to investments. And that investment universe in asset allocation is governed by Regulation 28. And we've seen a move, which is not just local, but offshore, toward more allocation towards private markets and other asset classes outside of the conventional listed asset space. Now, Regulation 28, effective Jan 2023, which was the last amendment, served to distinguish hedge funds away from alternatives or private markets. Yet in South Africa, as an investor, you would categorize that as alternatives. And it's also served to raise the investment ceiling for private markets and what South Africans can now access in terms of a global universe of unlisted exposure, skills, expertise, and diversification of return. So in terms of private equity, that limit was increased to 15%, and infrastructure investment now also specified at 45%. And if including Africa, that number's moved to 45%, including Africa XSA, in terms of infrastructure exposure, specifically within retirement funds.